Take a look at Nigeria's consumer goods sector using half-year earnings of Nestle Nigeria. Let's see now. Revenue up to 30%, 222.5 billion naira. Gross profit 80.2 billion, 21% climb. Their operating expenses also climbed by double digits. Net profit 28% rise year on year, 27.7 billion. Joining us to talk about Nestle's earnings and also the consumer goods sector, Chinma Ukadike, who is a Sub-Saharan Africa consumer goods analyst with Vetiva. You're very welcome. Thank you so much for joining us. Good morning.
Good morning.
Let's hop into it. What can you talk to us about the revenue triggers for the company as far as, why they're able to post a double-digit revenue climb year on year?
Yeah, so when we talk about revenue, usually the driving factors is usually due to two factors. So you're either looking at volume or you're looking at pricing, or a combination of both. So in case of Nestle, for the H1 period, it was really due to both factors, revenue, pricing and volume, really drove both. But particularly in the case of Nestle, for the H1 period, we saw more growth coming from the Q1 period, which was really driven by higher pricing in that period compared to the previous year. So also because of Nestle's positioning in the market in terms of their brand visibility and their market leadership and their innovativeness, they're constantly innovating with new products, improving SKUs and all of that. I think that's why we saw that affect volumes, and then because they had been able to increase pricing, as we had seen across the sector, really, those both factors combined together was able to prop revenues by as much as we saw, like you just said.
Very interesting, thanks. So a lot of that weighting on for the first quarter was responsible for that. Okay, so if we look at food and beverage for half year, I think we saw double-digit growth in both of those sectors. Is that also, I guess, pricing factors, pricing and volumes for that as well?
Heavily, I think pricing really is the major factor driving such growth that we've seen. But we can't discount what volumes have done so far. If we look back to the GDP numbers we saw in Q1, we saw that the food and beverage sector volumes grew by 9% year on year. So whilst we may not see that strength in the Q2 period, right, we know that volume has still been a good driver for revenue so far. So I think that what we've seen, especially in the beverage sector, where we've seen a lot of innovative products, we know that Nestle recently released, introduced their Nescafe ready-to-drink coffee. So that has been doing numbers, presumably in the market, and that has helped their beverage segment, in the food segment as well, in their seasonings space, where they are the market leaders. We have seen a lot of newer variants of the Maggi seasoning powder, and we've also seen them introduce smaller sachet.
I'm going to get to that in a moment. This shrinkflation. So go ahead. So those are the factors, yeah?
Yeah, we've seen that.
Costs. Can't talk about revenues without talking about costs. I think if costs half year 43%, what do we attribute that to? Is that the inflationary environment? Double-digit rise in costs for half year. What's behind that?
Yeah, inflation has been a very big driver for them. Another major driver is really the Russia-Ukraine crisis. Which has affected global commodities markets. We import a lot of commodities, like wheat, sugar, and barley, for example. At some point, we even had to import maize when there was the ban. So I think that has really been a major factor in driving growth in costs for the company. Another thing that has been driving costs of sales for the company is the large rise in oil prices. So we've seen with the Russia-Ukraine crisis as well, oil prices have been going up, and that has affected their operating costs and all of that. So that has been a major factor.
We keep seeing these trends. And
interestingly, that has been one of the factors that has driven pricing for the company. So in trying to keep up their margin levels, many of these companies have had to increase pricing in line with the cost increases that they've seen. So that's one of the factors that has driven revenue growth as well.
Interesting. Okay, what about finance costs? I mean, that I'm showing that was 138% rise year on year. So what's the drivers there?
So for Nestle, they have most of their debt is held in So
Wow.
with what is happening in the
my goodness.
Most likely don't even have to say.
Yeah.
With what's happening in the FX markets, we've seen a large depreciation in the naira. So with that, we've seen that they've had to report, although they didn't really explain that in their numbers.
Yeah.
We believe that the rise in finance costs, from FX losses that they've had to report was what drove the large rise. Because normally we would see that with Nestle's smaller debt balance and their large cash balance, they normally have positive net finance income. So this is quite an anomaly, and I think it's been driven by finance costs from foreign exchange losses.
That's heavy. Thank you for explaining that. So as far as the outlook, you mentioned their market position, market leader. If you look, can they maintain that over the short to long term? How do you see that playing out for them?
Yes, I think they can maintain that, and I think one factor that is in Nestle's favor is their innovativeness, like I mentioned. So because despite being the market leader, they're not, staying put. They're constantly bringing new products into the market and, constantly being in the consumer's face and, with brand visibility on their mind. So I think those are the factors that will drive, that will maintain their market position and will help them maintain revenue stable in the coming year.
Let's talk about the stock. It was flat yesterday. If you look at the, I don't know if you have a recommendation on the stock. I think it closed at 1,300 naira. It's down about 16% year to date. Is there what's your view on the stock price, I guess?
So I think we have a 46% upside on that.
On the target price?
Yeah. So our target price is about 1,900 due to their impressive numbers.
Yeah.
So far we haven't seen the stock price move as much, given their impressive H1 numbers that we saw. And I think it's due to maybe investors weren't as surprised, given their Q1 numbers, which were impressive. Investors had expected that they would do impressive numbers as well in their H1 period. And so we didn't see that movement. After the good results, we didn't see that movement in the stock price. So I think that's why. However, given our forecast for the company for the year end, we expect that the stock would get to 1,900. And Nestle is a huge dividend-paying stock.
It is.
Yeah. So
that's probably why so many investors hold on to it, and it's not very liquid.
It's not very liquid. Yeah, right.
Okay.
So with that as well, maybe about 6% dividend yield, we can see about maybe 52%, rise, appreciation in the stock. So yeah.
That's healthy. Thank you for that. So if you take a wider macro view of the consumer goods sector, is inflation one of the biggest headwinds facing it? How do you see that?
Yes, it
is.
It is the main topic in the consumer goods sector. So there's almost an unforgiving relationship between inflation and the consumer goods players.
Yeah.
You know how the consumer goods players depend on consumer wallets to drive volumes.
Yeah.
If consumers are suffering, who is going to buy your product? So with inflation, I think the last speaker that was here was speaking about how if you could buy 10 bags of a product before, with inflation now you can only buy 8 bags. So value is being eroded for the consumer, and with value being eroded, the value that your previous income could buy, is not the same, and so you cannot afford the same volumes for what you used to buy. So that's that's a great headwind for the players in this space, and not only that it affects what consumers can buy from them, it affects how their costs plays into their margins. It continues to erode into their margins, and they are forced to either stay put and absorb those costs, or reflect those costs in their prices, which then reduces their volumes further.
Right.
So whatever they decide to do, there's no win for them really. It's either you raise prices and hamper your demand and it affects your bottom line, or you keep prices stable
and your margins are impacted.
Hamper your margins and affects your bottom line.
Not easy. You mentioned that those sachets and the smaller. So shrinkflation, that's very much it's evidence in the consumer goods sector. Yes.
Yes, it is. And I think it's one way that these players have been, innovative in trying to keep up with the challenging times in the sector. So with consumers being hampered by inflation, many people cannot afford to consume the original quantities. If I used to consume 5 kg bags of rice in a month. I can't afford to buy that 5 kg bag at once. So now I can, if you give me a 500 gram, I'll prefer that. So that's what players have been, focused on to be able to maintain volumes at affordable price points for the vulnerable consumers.
So I guess overall, okay, but I've already mentioned this with the consumer. If disposable income is also being squeezed, that's definitely another headwind for the sector as well.
Yes, but driven by inflation, yes.
So what's, I guess, overall, looking at outlook on the sector, is Nestle an outlier? Because I know there's the Cadbury's and all these other companies which are also facing pressures. But overall, how do you think the sector is going to do?
So to your initial question, I think Nestle has shown superior margins compared to its peers in the market, whilst has seen declining margins. Everybody has seen declining margins, yeah. But Nestle has managed to keep theirs a bit more stable than the rest. So that's answering your first question. But then outlook for the sector, I would say that there are a lot of challenges. Inflation is one of them. We are continuing to see rising cost of commodities, rising operational costs driven by diesel costs and all of that. Yeah. So those will continue to affect margins, except they are able to raise prices and somehow manage to keep volume stable. Those will continue to hamper that. There's also FX challenges with how the FX market is currently. Many of these players have to import some of their varying degrees, some of their products or their inputs. So with what is going on, they might start to report finance losses if they have to borrow to do that, or they may just have to report higher cost of goods, given the FX component. But those are the challenges in terms of the opportunities that we see for the sector. Towards the end of the year, by next year, we'll have the elections, but as is customary, as is usual, before the months leading to the election, we see election spending, rise, and we expect that to support.
We know exactly what you're talking about. We won't say it, but we know.
We expect that to support
election spending, to support the sector, right?
Support demand as well.
Yeah.
And also for the Q4 period, which is usually a strong quarter for
because of festive volumes, period, right?
Then we expect that to also support. But I think the players that would stand out the most are those that are able to maintain that balance between raising prices at the point where consumers, are still able to maintain their demand. So you can, instead of doing outright pricing increase, you can do muted price increases so that, as you raise prices by 1%, for example, you're still not alienating the middle class consumers. Even though you've kicked out some people from the bucket, you have to, but you still maintain some middle class consumers. And as you increase, you don't just lose those middle class consumers because you've taken a 15% price increase, for example.
Gotcha.
So
interesting. Very, very. There's so many variables, so much complex high wire balancing acts that the players in the sector have to go through. And we thank you for taking the time to explain this to us. Chinma Ukadike, who's Sub-Saharan African Consumer Goods Analyst with Vetiva. Thank you so much for joining us.
Thank you.